I think so. I mean, I think if Netflix fits square into that bucket, right? One of the biggest winners of COVID and the fact that COVID simply turbocharged growth for a large portion of tech. And if you look across the board, the 2020 kind of pandemic winners and the story stocks, it's been a disaster now, and the headwinds have been brewing now for several quarters. Whether it's Netflix, Peloton, Zoom, DocuSign, some of the e-commerce names as well. I think managements are truly realizing that they were able to kind of over-earn, not just in 2020, but also in 2021. And now kind of as stimulus is being unwound and multiples are kind of compressing, rapidly to the downside, they're facing just unprecedented headwinds. And that's kind of been one of the, random kind of consequences of COVID overall, just kind of just uncertain environment. And I think the print from Netflix last night sort of is the poster child for the uncertainty moving forward for a lot of these companies. In my opinion, Netflix is trying to find some support here around 260, but I think a lot of these stocks are still dead money until you see a stabilization of fundamentals.
Okay, I want to do more on that. And guys, if we could throw up a 5-year chart of Netflix, I'd appreciate it, because I know the attention today is going to be on Netflix's reaction today. We're down 27% right now. That's going to be the big screaming headline. Yep. But on October 31st, Joel, Netflix was a $690 stock. So the 26% drop right now is extreme. It is dramatic. But we have now lost 63% of market value in what, 4.5 months? Yeah. Where's the floor here?
Yeah, I mean, if you look, if you're looking at the chart, like I said, Netflix held 260 back in I think December 2018, held that 260 level again in the fall of 2019. It's trading below there as we speak. You look at this chart, there's no reason why to think that it won't just drift slowly down to $200. Like, I just don't see real institutional money stepping into this story right now. Only because, like, I think last night, you look at the letter from Hastings, it's probably one of the most, grim readings we've gotten from him in quite some time. Just rewind 3 years, he was talking about Fortnite being his #1 competition. And now he mentioned Hulu, HBO, Disney across the board. You mentioned kind of they're contemplating some sort of ad-supported plan as well. And I think that strategy shift really kind of just, it lays out that they're facing unprecedented challenges from what they've kind of experienced over the past decade plus.
But you wonder, Joel, and I'm not going to ask you to dive into the world of media, but you look at the well-publicized struggles with CNN Plus right now, all kinds of reports the last couple of weeks about its struggles. It is so easy for people to sign up for something, pay $6.99 or maybe get a month or a week free, watch what they want, cancel it, and then move on to the next thing. And I'm not going to ask you to comment on like the media in general, Joel, but you look at any company with a streaming model, and by the way, maybe that includes us as well, and you got to wonder, is this sort of foretelling more difficulties for any public company, right? You look at a Discovery or whoever it might be that has this kind of product. Do you have a macro thought on that generally?
Yeah, I think you hit the nail on the head. And the key is, especially with younger generations, I'm getting up there, but younger generations, consumers become a lot more savvy. And just kind of, I'm sure there's already apps already being developed, if they're not already, out there, that are going to be able to help you kind of move from one service to another, whether it's, 2 months on Netflix, then you go to Disney, maybe you sign up Paramount Plus, you go over to Warner Discovery. I think that's going to be the biggest challenge for a lot of these streaming services, is that churn level is going to continue to rise and probably stay elevated. And that uncertainty is just going to limit the upside to the multiple moving forward. And I think that's obviously just more of a result of a tech savvy, younger generation, people growing up with smartphones, having the ability to jump from one service to another. You don't need to call, a customer service number and put on hold for 30, 40 minutes. You can do it with a couple of clicks. And I think that's what you're seeing right now in the streaming world. Obviously Netflix down 26%, but all the other names, Roku, Warner, Paramount, down 4 to 6% in the pre as well. Like, I think it's becoming a little bit more difficult to justify the amount of money these media companies are spending to support their streaming platforms. And again, the outlook's all going to be a little bit more muddier than it was a couple of years ago.
We can lose money on every subscriber, but make it up in volume. I mean, your point on being able to cancel is well noted. So just to get back to the stock, Joel, we don't hold here. I know we're below 260, that level. We're at 255 or whatever. We don't hold today. You think 200 could be one of the next key levels to watch? I mean, that's grim.
Yeah, and I'm in that camp. I've kind of, thankfully, I'm staying negative on these 2020 story stocks, and I think COVID's that big of an impact where like I said earlier, it turbocharged growth for many pockets of tech, and now you're seeing all those tailwinds just completely reverse, and it's been the case since Powell kind of shifted his messaging in late November, early December. But again, keep an eye on earnings in the coming weeks from some Zoom, DocuSign, Etsy, and I think it's going to be pretty.
Yeah.
Sure. There's better parts of the market to be in my opinion.